All right, want to thank you for watching another Startup 360 podcast. My name is Garrett Stuckey. I'm the host. Please do me a favor, subscribe to the channel, give us a like, and share with all your friends. Today I have Joe Morrison, who is a lawyer that works with a lot of startups here in Ann Arbor, and really excited to have Joe with me here today. So thanks for coming on.
Sure.
Yeah. So why don't you just start by just kind of giving us an introduction of yourself, kind of high level, how you got here, kind of thing. So
Yeah. So I've been in Ann Arbor for the last 9-ish years. So I moved here in 2010. Went to law school at Michigan, and then just kind of fell into working in the venture space. So it's great. Lived in Ann Arbor for 9 years and started kind of focusing on venture work and company side representation of high growth startup companies, both like venture backable and then just retail, restaurants, kind of all over the place. So it's fun. Joined Bodman after a stint at a startup and then started my career at another firm. So always been in Ann Arbor, based here, don't travel very far, don't commute, so that's the deal. It's pretty good.
Nice.
Yeah.
So you came to U of M for law school, and when you got here, did you decide hey, when I go into law, I want to work with startups, or were you imagining yelling in the courtroom and kind of changed your course?
No, I mean, I don't, I started my career at Accenture, so I graduated from college with a finance and accounting degree, and then I was at Accenture for 4.5 years working as an IT consultant and decided that I probably was going to go to grad school eventually. So I just decided to start with the LSAT, and I just took it and got a score, and then the score allowed me to apply to a couple schools, and I only applied to 3 schools. And it was partially driven by where my wife and I wanted to move and just see what would allow her to keep a career. And then I fell into going to Michigan. It's the best school that I got into, and wanted to move back here because my wife is from the Brighton area. So then just kind of found coursework I enjoyed and found what firm I got a job with after school and where they assigned me, and I somehow ended up in their Ann Arbor office as their first associate, working for an attorney that did virtually all of the venture work, kind of the foundational levels of Michigan's venture scene, and that kind of led me to specialize, and that's how I fell into it. So a lot of decisions that just kind of led to the current place, so pretty interesting.
Wonderful.
Yeah.
And was there, so it was just interesting, was there something special that caught your eye, or just you just love the field as a whole?
I mean, I don't mean to frame it as it's something that I came to by not liking the other things. I don't love to write, so that takes litigation off the table. I don't love to fight with people, so that generally being in the courtroom is just not something I enjoy. So transactional work, which is M&A, real estate, buying and selling companies, venture capital work, that's all fun. Negotiating is fine, and I think in a business context, especially on the venture side, people's interests are aligned, so folks are looking to grow. Nobody ever wants to spend a ton of money on lawyers. When you're a venture lawyer, a lot of times you're providing super high value feedback, which is, I've worked with dozens or hundreds of companies. What have I seen go right? What have I seen go wrong? As opposed to just kind of being a pure play M&A lawyer, where you're just doing a lot of documentation of the business person's deal. I really like providing business feedback, and I don't like a lot of the other areas of law, so it's kind of a great overlap with kind of my skill set from the accounting and finance world, and just general business, and then having a law degree. So.
Great. Okay. Awesome. So now you currently work with on the startup side and the company side versus the VC side of things. Is that my understanding?
Yeah. So probably 75-25 company investor. So it's tough, especially in an ecosystem like Michigan. You could be investor side and company side, but a lot of times the high quality companies are taking money from the high quality investors, and you can't represent both sides of a deal.
Yep.
So a lot of the investors that we represent don't invest in Michigan early stage, like seed stage startups, which is kind of where I focus, representing the company side.
Okay.
So it's a nice mix of, I can do the investor side work, but it's folks who aren't investing in like the bread and butter of where my company representation is. So
Gotcha.
yeah, so 75% company side, 25% investor side, I would say.
All right, so that gives you a good view of kind of both sides, how both are thinking,
Yep.
kind of ways to, grow those things. So, with kind of with that, is there? Let's talk more about the Ann Arbor scene first, because it's as we both know, it's a really flourishing scene. There's a lot of
Yep.
great growth going on. Now, you've been in this space for 9 years here in Ann Arbor, so what have you seen that's been especially cool for you?
More money, which was really important because you can have fantastic, you can have fantastic ideas and fantastic companies, but if they don't have any money and they can't pay anyone to build their idea out or go, market so they can get customers or pay salespeople, it's hard to grow a company. So a lot more people investing freely, taking risks earlier on, and I think it's come a long way. I mean, there's a lot farther to go, probably more ground to cover than we've already covered in the past 5 or 10 years. But a lot more active seed stage investors, which is great. A lot more attachment to other high quality ecosystems. Chicago's grown up a lot. Grand Rapids is a great ecosystem. Detroit is making a lot of progress. Indianapolis has a great ecosystem. Pittsburgh is growing. Columbus is growing. So the networks are all starting to come together.
Okay.
And then you have, exits. Everybody talks about Duo, but you have LlamaSoft, which is in our building. You have, a lot of huge deep field networks selling to Nokia. You've got a lot of major exits and a lot of people who are coming here from the coasts or leaving here and going to the coasts and bringing back connections. So that's great.
Okay. Yeah, I was going to say, so where do you feel that this money is coming from? Is it people locally learning about VC investing and starting companies? Is it a mix of East Coast, West Coast money?
Yeah, some West Coast money for sure, for some of the more prominent companies. We've had a couple of exits and people are starting to circulate that money back in, so LlamaSoft's exit was great. And I think there's a stat that Ann Arbor has had, $100 million exit every year or something for the last 10 years, and nobody talks about, these larger exits like 4C. Results was a huge exit, and a lot of those folks started investing and have spun off other companies. A lot of the, Oakland County and Washtenaw County wealth that was more traditional, like auto supplier manufacturing, they've tacked into venture as an alternative asset. A lot of the wealth managers are starting to understand that venture investing can be super lucrative for their clients. So it's a combination of wealth from the West Coast and then people realizing that, investing in startups is a viable part of an overall wealth management strategy. So,
Awesome.
Yeah.
And so, I guess now you work with Spark here in Ann Arbor. You've also done work with University of Michigan. What have those roles for you kind of been like? What have you kind of learned, maybe even for somebody that's maybe in a very early stage of a startup, or even just like still eating ramen and the only coder in the basement kind of thing?
So a lot of what I do for Spark and U of M, I was a student at U of M, and they have something called the Entrepreneurship Clinic, which just provides free legal office hours to students at Center for Entrepreneurship in the engineering school, Ross, and then other schools around the university, mostly undergrad, some post-grad students. So I'll do a lot of lecturing one-off for clients who teach classes. I'll do, Center for Entrepreneurship panels. I help out at Desai Accelerator occasionally, just doing legal office hours. I'll do startup law 101 presentations for TechArb or Spark, or we'll do focus presentations on areas that are interesting. But then I try and make myself available as much as possible to provide feedback on trends. So U of M does phenomenal job helping the students realize that there are issues that they need to prepare themselves for in kind of like the quote-unquote real world for graduates who go and start companies. Spark does the same thing. Obviously, they're focused on people who are tacking from the real world kind of into a startup. They may have had a job, so non-traditional, non-student entrepreneurs. So it's just helping folks create content or pushing out educational materials or speaking or mentoring teams. Spark has a boot camp that's fantastic. So it's really just being a volunteer in the space for those folks.
Gotcha.
Yeah.
And why do you volunteer in that space?
Volunteering is much better than typing emails to people. So that's part of it. But yeah, there's just so much. I don't know if I didn't have 10 years worth of work kind of in this space, how I would ever wrap my head around, the business side of startup, the culture side, how you figure out how to build a team. And then, the last thing that people think about are like the legal and accounting needs, but they're kind of foundational items, right? You can't just start a company and get it all wrong. Or those issues, like the legal and accounting issues that are baked in the first year, they'll crop up later. So I volunteer partially just to save people some headaches, and then second is just like I enjoy helping people avoid the avoidable potholes. And it's really not difficult, right? There's just not a whole lot of levers to doing things correctly. But there are a lot of resources and there's a lot of bad advice floating around. So very little time spent volunteering provides like an outsized return for these startups.
Gotcha. So what are some of those potholes that you wish like every startup founder would know about day one?
A lot of people just punt on really hard decisions. So especially in the teams that are 3 to 5 founders, everybody just has this gut feeling that one of the people is just probably not somebody that's going to pull their own weight. Startups are a lot like a group project in that way, but when you have a group of friends and everyone wants to come in and split the pie equally, right? 3 founders all get a third, or 5 people each get 20%. And everybody knows that the value proposition of each person is different, but they don't have that discussion. Like, it's much easier to have a discussion up front where people say, you're less important than these 2 people who are the developers, right? You might be a business person, but we can find a ton of business people. We can't find 2 full stack developers. Or we really need a UI expert and a design person for this social media app. We don't need somebody who has a PhD in something else, right? So they let social bonds drive a startup team rather than like business needs. But if you're going to really make a go, like, it's going to be a business over favoring one person. So first mistake is just really not thinking through and acting on your gut feeling of like what the team needs and what the team needs to look like in the first year. Second is people don't accurately project how much money is required. So, you can't quit your job if you won't be able to pay the bills in 3 months. And that stresses a lot of people out. And then if you're 3 months in and trying to scale a company while you're trying to look for a job that will be flexible enough that you can still build your company while paying your bills, that's really hard. And then the third, just general legal potholes are, people don't document their equity grants correctly, or they promise out way too much equity to people who don't deserve it, or they sign whatever agreement is presented to them by third-party contractors or consultants or potential customers, and they give away their intellectual property, or they're not, they're just not being diligent about reading and understanding kind of 101 level legal stuff. So,
gotcha. Okay, those are great points. I think the conversation around with founders, saying your split is only worth this much, or hey, you're great and all, but we don't really need you. I think that's a really tough conversation.
Super tough. Yeah. But it doesn't come out of nowhere, because people think about. Everybody has that feeling, and it's just like acting on it. Because if things go south, then you say, "Wow, that person wasn't worth a third. They're not even worth 20%." It's much easier to have had that discussion and gotten that person to 25% up front than being off by half. So it's hard to get precise, but people just need to honestly communicate and get things out on the table rather than let them fester. So.
Gotcha. Are there, now for somebody that's maybe that, hey, you're only worth 20%, but the rest, we're each worth 40%, with 3 founders, how do you navigate that as that 20% person, or like because you've seen these conversations, and would have been some kind of, I guess, unique things.
I don't know, it's just depending on whether or not you're fine, or there's like an ego aspect, or you genuinely believe that you're worth a third, or the other people aren't worth 40. So part of it is, I don't like it because I don't feel like I'm worth 20, but which one of the other 2 founders aren't worth 40, right? Because there's only 100%, so it's a zero-sum game. So a lot of it is just, hey, are you fine, right? If this sells for, $10 million, are you fine getting 2? Mm-hmm. And if you're not, and you're fine being outvoted, because somebody who has 20% usually is not going to have a ton of control over the strategic direction. If you're not fine with those things, then don't do it. And if you are fine and you really believe in where the startup is going, you think it's worth the risk, and you trust the other teammates, then roll forward with it. So percentage is really important, not for the percentage, but more for the what that percentage is a proxy for. So
gotcha. Yeah. So it kind of comes down to what is your believed valuation, because 20% of $1 billion company, for example, is a much better thing than a $10 million company.
Yeah, and I don't know. Are you all paid the same salary? Are you paid different amounts of money?
Mm-hmm.
Are there certain things that you want input in? Are you going to be on the board? Are you going to be CEO? CEO doesn't have to have the most equity, but maybe they have the most day-to-day control. So it's really like those equity conversations and what it touches in, like how important are you for us? Those are just key conversations to have.
Awesome. I appreciate you sharing those things. What other, so you kind of, earlier you said there's a lot of money coming into this area, which has been really great. And, I think people are definitely starting to see that effect in some way, just because there's conversations about startups.
Yeah.
What other, interesting trends are you seeing here in the Midwest, and maybe what are some differences compared to, San Francisco, West Coast kind of thing? That's maybe a great reason to have a startup around here.
Everybody always talks about the cost difference. It's 40% cheaper to have your startup here rather than there, right? There being whatever giant coastal city. I don't know if the cost is that important, because it doesn't take into account, the value that the services, the value of the services that a startup gets, right? If you have to pay somebody less, that's only great if you're receiving the same level of service, right? So Ann Arbor especially has just a crazy level of talent. Whether or not you can acquire the talent is another thing, but there are a lot of really top shelf engineers or a lot of super smart students, and it doesn't cost you a ton to go get those people on your team. You can certainly work from here and have just a cheaper mortgage, and a shorter commute, but I think the talent level is also phenomenal. On the downside, in the Valley, it seems like people will, and increasingly in Chicago, you can kind of walk down the street and like trip over people who are angel investors and raise money a little bit easier. It's still really hard to raise money in Michigan. You've got a lot of seed funds that run around and still give startups the excuse that they're too early when they have customers and revenue, and the concept that a seed stage startup is too early when they have customers and revenue is borderline laughable. But I think the main benefit in Michigan generally is just like a super high talent level, really in Ann Arbor, really diverse ecosystem, and you can still hop on a plane, like go to Metro Airport and get to wherever you want really quickly. Whereas in the Valley, like it's a bubble to some extent. A little harder for you to leave San Francisco and just like go pop up in the Midwest and have a network, but you can certainly with one intro here get some intros out in the Valley and make yourself a network. So
great.
Yeah.
Awesome. We're seeing money kind of coming in from the West Coast, and we're seeing obviously more money around here, more people paying attention, and you mentioned Pittsburgh, Chicago, Indianapolis, Grand Rapids, which is really fantastic. And you kind of mentioned those networks kind of coming together. What is that looking like? How are these? I mean, they're obviously Grand Rapids is only 2 hours away, right? So that makes sense that how are those networks joining together and helping each other?
There are various things that I think have been really helpful. So probably the best angel group in the state, one of the oldest, is called Grand Angels in Grand Rapids, and then they started a branch in Kalamazoo called Kazoo Angels, and now that same group is kind of running the back end of the new Woodward Angels Fund in Detroit. So you have a lot of the experienced folks who are kind of moving across the ecosystem. And really starting to pull networks together because you've got kind of the same 10 people who are at the core. You also have Pitch Club, which is something that Kaiba and Raymond and Bodman have supported among other stakeholders. And that's a traveling pitch competition, so it goes Ann Arbor, Detroit, occasionally go to Automation Alley in Troy, I believe. They go to Lansing, they go to Grand Rapids. So you get people who are actively trying to cycle through the ecosystem. And then a lot of people will go to Chicago because they have investors. There are a couple of fantastic early seed stage and mid stage investment funds in Chicago and northern Indiana who will invest in Ann Arbor. And that's great. And then there's always events like the Midwest Growth Capital Symposium that have always had pull from kind of broadly the Midwest region, and it's super helpful. And then U of M pulls people in from all over the country.
Yep.
And then as U of M's alumni base increasingly gets into the startup ecosystem, when they end up making a pilgrimage back to Ann Arbor, they bring their connections with them. So there are various different ways, but the Midwest is geographically large, but network, very small place, and getting smaller.
So kind of to pivot a little bit here, obviously, as a startup working with VC and angel funds, do you do a lot of advising on whether or not to take that kind of funding, and what are kind of some like general guidelines that you might use for a company, or like give advice or what to think about, I guess?
Yeah, I mean, it's pretty interesting because people say like, oh, that's a business decision. Lawyers make legal decisions, and the investors of the company make business decisions, but any law firm's tagline is lawyers and counselors, or it's more than just being a pure play lawyer.
Yeah.
And especially in the startup ecosystem, it's no different than top private equity lawyer, right? They know the deal terms in and out because they do a high volume of private equity work. So on the venture side, we can pretty accurately and pretty confidently say like a term sheet is not a market term sheet, right? The terms are too onerous for the company, or the terms are too light, right? The investor could ask for more, or say that a particular transaction doesn't necessarily make a ton of sense at a particular stage, because we do so many of these transactions.
Yeah.
It's not like we're real estate lawyers who are dabbling in venture. It's just kind of pure play. I work with emerging growth companies and some of the early stage investors. So I wouldn't do that about a real estate deal, but on the startup side, yeah, we definitely give feedback about whether the terms the company or the investor is offering are appropriate, whether they just generally make sense, whether a company's in a good position to be investable, strength of a team. So yeah, 100% give that feedback, and it's just based on like a ton of data points.
Gotcha. And are there things that you would are there ever instances where you're like, hey, you don't need to ever get investment capital, maybe you're making enough money on your own, or are there other, I guess my question is like, what are some signs and reasons to take that investment or not to take that investment that you've experienced?
Ultimately everything is the company's call, but there was one client that got a term sheet, and I think that the CEO knew the term sheet wasn't great, but felt a ton of pressure to take it, because when you get a term sheet, always take the money while it's being offered, and I felt like it was a terrible term sheet. And ultimately, the client decided to turn that down, and then found another investor that made a much better offer. But to get from turning the term sheet down and stretching a ton to getting a second term sheet, a lot of that was just like I will help push people, a little bit, and that's my role, like being the bad guy in some of the negotiations too. Sometimes good cop, bad cop is just like pushing really hard and making people stretch their boundaries. And we definitely will say like, you shouldn't take that money, or you should, or I will at least. And it's never my call. If that person said, hey, I appreciate it, thank you, pats me on the head and says, you're still going to do the deal, I'm definitely going to help, right? Fall in line. Because I want to help the client succeed. But yeah, I'll definitely provide my feedback.
Cool. Let's see, what was the question I had? There was, are there, when you're working with these startups and they come to you and they say, hey, like we want to start looking for capital, is there some advice that you give them? Obviously you probably have a network of investors that you probably refer them to that you've worked with in the past, or I guess let's keep it more for somebody listening, like what should they be doing if they're going to start looking for that type of funding or consider it?
Yeah, so you definitely need to be really tight. Like, do I have clients? Do I have a product? Is there a market need? Have I done my homework? Mm-hmm. Do I have a team? What's my value proposition? A lot of people say, I want to raise $3 million at a $10 million valuation, but they don't have a product, right? They don't have any customers. They don't have any pilots. They don't have any IP protection. They don't have a team. So there are a lot of just like really basic things that you need to do to make, as one of my colleagues says, like make yourself investable.
Yeah.
And then do your homework too, right? So before you raise money, you need to have a pitch that makes people feel like you deserve money and you have a really bright future. And until you have that really clearly laid out, and it's a really strong, compelling offer, you probably just need to keep working.
Gotcha.
So yeah, a lot of people try to fundraise, and it's just like fundraising is really hard because you don't have anything that's super compelling, and that's not always the case. But a lot of the people that are talking about raising first, like they haven't built a team that inspires a ton of confidence, and they haven't bought a product or they haven't created a product that is, really sticky that people would want to buy. Like, don't fundraise until you're there. So
absolutely, it seems like the further along you get on that path to, the more you're able to leverage in terms of like maintaining equity. Your term sheets are going to be better.
Yeah, 100%.
Right.
Yeah, you want to raise from a position of strength, which is, obviously the position of the most strength is I don't even need the money.
Yep.
But I'm raising. You don't want to be raising when you only have like 2 months of cash left in the bank, because then the investors weigh you out until you're desperate. You don't want to be raising when you are dealing with uncertain technology, or your team just had key departures, right? You want to be raising from like, hey, I just did a product launch, or I just did a product update, and it's going swimmingly. That's fantastic. Or I just signed a giant enterprise customer or something, right?
Yep, absolutely.
Yep.
Okay, yeah, those are great points, and I think a lot of them seem obvious, right, when you start talking about it, but I think there's this like, you can get in this rabbit hole of like, oh, we need money, we're not doing, like, we got to get it so we can get big and do that, and I think that can really trip up a lot of people.
Yeah, and that goes back to like did you do your financial projections? Because there's a founder in Ann Arbor who worked for 5 or 6 years full time while working on his startup that he subsequently sold either all or a majority stake in. He's like, yeah, most people think that they have to do this full time, but like, you can do it full time if you have money to pay your bills, but otherwise just work super hard.
Yeah.
At night. There are hours for your passion projects, and you can make it work. So yeah, people talk a lot about raising money. Not always a need. A lot of times it's like a want, or has been brought forward because of circumstances that you could have avoided. So yeah.
In the kind of to switch gears a bit, for the investor side, what are, I guess, some key things that you have found has really helped them? And I guess kind of the same thing, what pitfalls maybe if you sold your first company and now it's, even if it was a restaurant, right, you have some money to invest, I'm going to be an angel investor, kind of.
There are probably 2 camps of investors. There are many, 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 but 2 like angel camps, and one is I'm investing in something I like, and they're making an investment based on, I think this could be really interesting. I'm just, going to cut the check and pray, and there's, some level of trust, which is totally fine. It can work out really well. And that fits more the angel mold that people think about. It's like, oh, I'm just gonna cut somebody a check because I'm an angel, right? I can afford it, $50,000, and if it goes to zero, it goes to zero. But a lot of times the people in that camp, like, through their actions and not doing any of their diligence, they actually have increased the chance that their investment goes to zero, or they're diluted way down, right? They don't understand the company's financials, prospects, how the company will be financed going forward. They may understand the technology, but there are a lot of good companies with really good technology that fail for other reasons. So the second camp is the folks who maybe try and understand to the T every single operational detail, because they may have sold their company and they knew everything about their company. So before they invest their $20,000, they try and understand an investment target like they would their own company. And I don't, I don't know that either camp is, the superior camp. They're just very different. So I think it's important for founders to like identify, which of those buckets somebody falls into.
Okay.
Just like make sure if you don't have a ton of time that you're not dealing with the second camp, which is going to be, weeks and weeks of due diligence. And, with the first camp, it's making sure that you're actually proactively telling somebody who's just cutting you a check on a prayer, like aligning their expectations to what reality is. So that they understand a lot of times that first camp, like they'll expect money back in 3 years. And usually if you're an angel, it's a 5 to 10 year return until you see any money, if you ever see it.
Yeah.
So both sides have different pitfalls. But on the investor side, I would prefer that somebody fall into the second camp where it's like actually understanding and orienting their expectations properly than the first camp, because I've just seen a lot of people get burned when they trusted the founder and they had no idea what they invested in, and then their money went to zero. So,
gotcha. Are there instances even where even if the company survives, maybe they're not getting the returns that they thought they were, and so like I invested $50,000 in it, maybe I get my money back in 10 years and I get $60,000 back, or have you seen those kinds of things play out? Or
yeah, and usually that's because people just were diluted way down. So there were multiple financing rounds. When you're an investor, you come into the first round. Everybody who comes in later comes in on top of you, and they will get the money out, and you'll get what's left. Probably more than the founders will get, but you're still way down the quote unquote waterfall of proceeds when a company sells. So, you want to make sure if you're coming in, you understand how many future rounds, how much dilution will be there, what the timeline is to sell, right? How much time your check gives the company. And that will let you know, right? I mean, if the company is a pharma company, needs to raise $100 million and you're putting in 25, you're going to get diluted really far down, and you may not get much money back. And then you also don't want to put money into a company that's in a distressed position necessarily without some, significant security that if the company is sold and, they're sold at or below the valuation that you invested in, you may get a slight premium, but not enough to compensate you for your risks. So.
Yeah. Okay.
Yeah.
Good points. So, with the, I guess like working with these startups, what are some common themes that you see with the more successful startup founders?
The more successful startup founders, they probably just work harder, and that's a really tough. That's a really tough thing to say, because just because you work hard doesn't mean you'll succeed. But I would say the really successful founders that I work with, like, the company's just a core part of their life. They just work a lot.
Gotcha.
And my wife says I work a lot, and I think it's minimized by the fact that I work with some people who I've worship their work ethic. Just merciless. Like Saturday nights at 10 o'clock, I'll get emails because they're working. So they're just super hard workers. And they love what they're doing. They're obviously focusing on important things, right? So value and return for their time.